All right, what's going on, everybody? Today we're going to talk about how understanding the higher time frame and draws on liquidity are always going to be what makes or breaks your trading. A lot of people seem to think that your entry model, or do you enter off of IFEGs or do you enter off of change in state of delivery, like et cetera, et cetera. Most major traders and people who are profitable only care about getting the draw on liquidity right. Okay? And what is the draw on liquidity? It's basically just saying on the higher time frame, are we bullish or bearish? What's our bias? And then what obvious liquidity pools line up with that to the upside or downside that I think are going to get hit. So let's just go through an example, right? So coming into this random day, you want to go from top to bottom. So first we're going to start on the daily chart. The daily chart looks horrific, extremely choppy. Then you're going to go on the 4-hour chart. Okay, what are we doing right now? Well, in our last 4-hour candle, we inverse this gap to the upside, and we're currently inside this 4-hour bullish gap. Then on the hourly chart, however, we started selling off here. After tapping into this hourly gap and sweeping London highs, we are now inversing this gap to the downside. We have London and Asia lows stacked below as well. Just keep on going through and try to get a narrative of what's going on. We also have this 30-minute gap, which it looks like we tap right before open, so that could be a potential play. So for me, the higher time frame looks a bit more bearish. That 4-hour inverse didn't really deliver us any higher. Seemed we reacted off of it immediately. The hourly looks extremely bearish. And then this 30-minute opening and then getting tapped right before open also gives me a potential sign that we just want to sell off to these lows. So, what have I done? I've gotten my bias. Okay, we are going to be bearish for this session, in my opinion. Now, I think, okay, what are some obvious liquidity pools that I could target? And that's when I go back to these higher time frames and I think, okay, what do we have? So first of all, we have this unfilled 4-hour gap down here. So then on the hourly, what do we have? Well, we're going to be delivering through this gap, and we have London and Asia session lows. So I want to see Asia and London session lows get hit as well, kind of stacked lows there. Then some other very good targets are intermediate lows or highs, meaning lows or highs that are inside of fair value gaps. For example, on the 30-minute time frame, as you can see, we have this low that's inside of a 30-minute gap. So I'm bearish. I want to see at least some of, if not all of, these liquidity pools get hit. So now is when we talk about entry models, right? So let's see. When did this gap get made? So it seems like we tapped into this 30-minute gap pre-market. And so if you were able to have gotten in, if you trade pre-market, you would have already smashed TP if you were going for a 1-to-1. But all that matters to me right now is, okay, I have my bias and I know what I think is going to get hit. I have my bias and then I have my draws. So let's talk about getting actually in the trade. So we open up this 5-minute gap right and tap into it right before open. You can see right here. It's another pre-market opportunity right here. So you could, even though it's close to open, I don't trade before open, try this short and aim for like a 1-to-1 with this low, right? Now let's see what happens at open. So this is why I don't trade open, because it spikes up like that. And then what happens? Boom, we immediately take out London low. So there's our first draw that we had marked out. We wanted to see London and maybe Asia get taken out. What did we also do? We also took it out on ES, right? So we have taken out London. We have swept liquidity. I don't think this is going to let me use the 30-second. Oh, it does. Okay, nice. So we have internal liquidity. We have London sweep, so our first draw has been hit. And now we start talking about possible setups. Because remember, draws on liquidity, the best way I can possibly talk about them are areas where if I were to be confident in price going in that direction, that would be where I think we could get a reversal. For example, I said London low and maybe Asia low are draws on liquidity, which to me means that if I were in shorts, I would want to get out of my shorts at one of those targets because that is a draw, and that's where I think price may be like, okay, we've hit our liquidity pool, and now it's time to reverse. And what do we do here? Well, we get a 30-second gap right here, and we reverse off one of those draws that we had marked out. Then, as you can see, we have a high here. We can maybe go 1-to-1. What else is this, by the way? This is also a nice little AMD model where we manipulate right at open down to our drawn liquidity. So right at 9:30, this is perfectly my model. And then as you can see, this banks immediately. Now, let's talk about, I don't know if there was any news on this day, but now let's talk about this long. What did we have above here? Well, this 5-minute gap had already been tapped into, but we had another 5-minute unfilled gap above. We go to the 15-minute chart. I'm not sure if there was anything there. No. 30-minute chart, we have this intermediate high. So for me, I'm like, okay, we have this unfilled 5-minute, which funny enough is basically what I ended up targeting anyway. So that would be our first draw on liquidity there. And then we have this intermediate high above. So maybe you could think of taking runners. So you could take out most of your position at the 1-to-1, and then you could leave a runner just in case you're confident in price coming up to that intermediate. As you can see, it doesn't. And then we retrace. Maybe we take out Asia. Yep, we take out Asia, and what do you know? Then the cycle continues. We get our entry model again. No 30-second. Let's see if there's a 1-minute. There is. Jeez. There's a 1-minute gap here. Get the inverse, stop below the low. And then you could try to take it for, whatever you want. You get fucked, clearly. But, what's it called? Then we seek out what's next. The 30-minute intermediate. To be honest, we probably get fucked here because we hit a 5-minute gap or something. Yep, called it. God, I'm such a genius. So, it's all about moving from external to internal liquidity pools. So, right here, on this trade, you get your drawn liquidity hit, which means that it's time to take a reversal. I actually wouldn't take this trade because I only trade 9:30 or 10 o'clock or continuations. So I wouldn't take this trade because this is just like a random reversal to me. The trade I would take is an inverse off a tap of this. So I actually, funny enough, would have taken this. Dude, what was this, March 12th? Jesus Christ, this day was fucking awesome. Let's see, just so you guys know I'm not bullshitting, let's go to March 12th. Did I trade on March 12th? Yeah. Yeah, it was this continuation, funny enough. So I actually didn't even take this long off open. I'm assuming because I wanted us to probably probably have an SMT at London. That's probably why I didn't take it, to be honest. But yeah, this one hits for 1-to-1, and then this trade gets fucked, and then, or gets break even, I would probably assume. You would probably go break even at the 5. And then you get your continuation short win. So it's just all about going from external to internal. What do I mean? Well, these are external liquidity pools. These hourly lows, this low, the 4-hour gap down here, all of these are external draws. And then the internal is what we're making on the inside. So this 5-minute gap. For example, we swept Asia. If I wasn't an IFEG trader, I could have just had a level and then I could have just traded it to the unfilled 5. This is a perfect example right here of going from external range liquidity to internal range liquidity right here. You hit the external liquidity pool, and then you immediately shoot up to the internal 5-minute that you make, and boom, money. I don't know what your stop would be. Maybe it would be, I don't really trade levels, so, but, that's an example of how you should be reading liquidity. Draws on liquidity are areas where if you were to go in shorts or in longs, then that would be your last chance to get out. What I mean by that is this 5-minute is acting as a draw on liquidity after we sweep Asia, because let's say I get in here and I'm like, okay, I do not want to see, or I'm in longs and I think this 5-minute could potentially reverse us. So this is my draw on liquidity, okay? So if you're in longs and you see an unfilled gap above, or you see an hourly high or some shit like that, or an intermediate high or low, then you should probably use it as a target because price can, manipulate or reverse off of that. So this is a perfect example of it. We accumulate and manipulate and get longs right at open. So you have 2 possible wins here today, where we take external liquidity out, and then what do? We tap an unfilled 5-minute. Boom. external to internal. Then we hit that internal. What do? We sell off to our next external draw on liquidity. Following, remember what my bias was, guys. It was bearish. So as you could see, we're making structure. We hit a bearish draw, and then we pump. And then we hit a bearish draw, and then we pump. And those pumps are just retraces because they're following my bearish bias. So overall, you see what I'm drawing. It's still a downtrend, but there are areas where you could have banked off longs. So that's how you need to analyze the higher time frame. Okay, you always need to be looking at external versus internal draws on liquidity. You need to be focused on, why would the market potentially reverse off this area? What are we going to seek and destroy? If I only traded my bias, maybe I could have tried, this inversion off of the 5 minute that we tapped. That's not really a trade I would take ever, to be honest. But if I was just super bearish, I'm like, I think all of my liquidity pools that I marked out at the beginning are going to get hit. That'd be 4.5 RR. See if this 4 hour ever ends up getting hit. Yep, and there it is. So really your bias and your draws are very important because, like I said, draws you're probably going to get reversals off of. As you can see, I marked out what draws. I marked out London, I marked out Asia, I marked out the intermediate, and I marked out the 4 hour. What happens at London? Reverse and pump. We get our retrace. What happens at Asia? We get a retrace. What happens at the low? We get a retrace. Boom. Now we hit this 4 hour gap. I don't know if we'll get a retrace here. Boom. There's another reaction. So that's why the draws are so important. Those are areas where price should reverse off of. I always get on early at like 9:15 and I get my bias, I get my draws on liquidity, and then I focus on my entry model to line up with those. So yeah, that's how you use a higher time frame. And if you can lock down the higher time frame, it doesn't matter how you enter a trade. It doesn't matter, if you use IFEGs or change the state or market structure shift, anything like that. It just matters about, what your targets are and the reasoning behind your trade, the narrative behind your trade. And that's how you become more profitable on the charts.